Good afternoon, everybody. And hi, Tim. Great to see you again.
Hi, how are you?
Great. So, hello to everyone. We would love to hear where you're all ringing in from. If you could please share in the chat. I'm based in Mauritius and Tim is based in the UAE. And today we're talking about PPLIs. So I'm Caoilfhionn van der Walt. I'm the managing partner of Regan van Roy. We're a boutique tax advisory firm focused on Africa, inbound and outbound. And we often deal with high net worth individuals and ultra high net worth individuals. And over the years, we've heard lots of talk about the use of different types of insurance products in wealth planning for high net worth individuals. And we have heard rumblings, especially recently, about PPLIs. So we thought it would be good to have an expert in this field to tell us all we need to know about this topic. So we're thrilled to have you with us today, Tim. Tim is a Brit based in Dubai. He's been in Dubai for 30 years. Hey, Tim.
That's right. That's correct. I am British. I was actually born in Canada, would you believe?
Oh, really? Okay. Wow. We're crossing lots of continents today. And Tim is an expert in wealth planning for high net worth individuals. And your firm, Tim, is called, how do you say it? Do you say HNW Tax, or is there a shorter way to say it?
Yeah, well, HNW tax, but people in the biz, it's high net worth tax, and that's the kind of stuff that I do is purely high net worth tax advisory.
Cool. And Tim and I got to know each other when we were doing a webinar last year on the changes to the UK non-dom rules, which we all know has caused a big stir globally and has resulted in a lot of high net worth individuals leaving the UK to various jurisdictions, including, of course, the UAE and Mauritius. And that's when we first started talking about PPLIs. So, Tim, I will hand over to you. Let's just first see where we've got people calling in from. Let me see. I'll look in the chat. We've got people from the Isle of Man, from South Africa, Mauritius, Guernsey, Dubai. Now, guys, we would like this to be a interactive session, if possible. It is a fairly weighty topic, or can be. So please do chat as we go. If you've any questions, if anything is unclear, please shout, or if you've anything to add as we talk. So Tim, I'll be monitoring the chat and I'll interrupt if we've got any interesting questions from the attendees. So I'll hand over to you. Can you tell us in kind of simple layman's terms, what is a PPLI and why is it something we should be interested in?
Yeah, sure, no problem at all. Shall I go to a screen share for those who are into this? Yeah, and I'll just get all the information up. How are we? There we go. Can you all see that?
Yep.
Brilliant. So basically that's the landing page, and I think Caoilfhionn, you've done a fantastic job of introducing what we're going to talk about today. There's an introduction to ourselves. Obviously, you've done your introduction as well. People who do know me will obviously say nothing but bad things about me, I'm sure. But if people would like a more, I suppose, a fuller description of what I've been up to, as you rightly say, I've been based here in Dubai now for 30 years. One of my partners is a member of the Maximise family, still is. And until about a couple of years ago, I had a company called PPLI. And PPLI, at our point, we had about 350 staff around the world. Offices are all over the place throughout, obviously, Middle East and Asia. And a couple of years ago, we sold that to a FTSE listed PLC, which was, I suppose, bittersweet in a way, but it allowed me to focus more so on the high net worth advisory, which I could see was really needed. The number of families that I meet, not only in the GCC, but all over the place now, who are not getting quite the right advisory I think they should be getting. I think everybody assumes that because they're a super wealthy person or an owner of a country, that they're getting the best advice. And more often than not, I find that's not the case. So it allowed me to really focus on what I wanted to do. And of course, PPLI is just one of those tools that I go into. I mean, you touched already on the fiasco that's happening in the UK from a fiscal perspective, and wealthy people are leaving in their droves, and they will continue to do so. So I do tend to straddle my sort of, I suppose, my advisory typically between the UK and US. But for today, it's going to be purely an overview on PPLI. So, PPLI, private placement life insurance. The other sort of, term I hear is wrapper. And basically what we're looking at is an insurance structure that can hold a number of, or a complete different amount of assets. Most people think in insurance structures, you put in cash and you manage money, but private placement goes up to one stage further when you can put not only cash assets, but all sorts of other non-liquid assets, things like private equity, could be property, could be art, putting in things like jets, yachts, all sorts of different assets that you can move into a private placement structure to give you some basic needs that high net worth clients would like nowadays, which is typically things like they want their privacy back, they want asset protection, they want tax deferral or tax free. And you see, this is what PPLI can do. So this is not a new innovation. This has been around for quite some time, probably about the best part of 40 years. It's a US innovation. So what comes out of the US generally is frowned upon, but on this occasion, this is pretty good. It was designed specifically for high net worth clients and hedge fund managers. As you probably know, not just the US government, but most governments tend to frown at things like offshore company structures and trust structures because they feel that there's an element of opacity and what's going on, probably something nefarious. So, governments generally don't like those kind of things. But generally, governments get on well with insurance structures, and generally the insurance solutions are done in hand with the government. And this is not just in the US, but all sorts of places, the UK, throughout Europe. There are various insurance structures which have approval from their local government to enable investors, whether high net worth or whatever alternative, to obtain tax benefits for using these structures. Now, PPLI, as I say, originated from the US about 40 years ago, and it was purely for high net worth clients. Now, this is because you can use insurance structures in the US to mitigate not only estate taxes, which is 40% in the US, but also withholding taxes, which come in at about 30% per annum on your dividend income, okay? Now, estate taxes in the US, whilst we know Americans tend to get hit fairly hard by tax throughout their lives, they're looked after fairly generously by estate taxes. For example, in the UK, we have a nil rate band of £325,000, whereas if you're American, you have a combined allowance of about £24 million before you pay any estate tax, all right?
Wow,
By the
that's
way,
quite a difference.
It's quite a difference. Oh, and by the way, if you're not an American, but you have assets in America, the allowance drops to $60,000. All right.
Okay.
So there's an element of disparity. If you're American, you get looked after in estate tax. If you're not American, we're ready to hit you. Okay. So anyway, but I'm not going to specifically go into that. But this whole structure of PPLI was designed specifically around those who are, in that sort of 24 million and above, by dint of which you now become high net worth. And we can use insurance structures to mitigate tax. All right. So all we're doing is utilizing that insurance structure that was devised in the Americas with the approval of the IRS, for example, and using those similar structures now in the international space to give international clients the same kind of, I suppose, ability to protect assets, to regain their privacy, and to manage assets for intergenerational wealth transfer and succession, etc. Right? So that's just the overview and a bit of history of PPLI. Moving along, this is really what I'm referring to, right? So I think a lot of people, they want some privacy because when they are building intergenerational wealth, a lot of things can come out in the public domain, and people don't like that. By utilizing PPLI, you can get some privacy back. It's not a case of hiding. It's basically clients want that discretion. They want that privacy. So in moving assets around, as we know, traditionally, things like trust structures and offshore company structures don't give us that privacy any longer. There's been so much change in tax legislation around the world with regards to, disclosure of information. We have things like DOTAS, we have GAR, we have, all the general anti-avoidance rules, etc., CRS, FATCA, where basically governments now have full access to all the various registers to see what actually is going on in their structures. And I think most people should understand or realize that the only privacy you really have now is maybe between different family members, but to a government, that's very difficult to achieve. So hopefully with PPLI, in combination with your structuring, This can bring some robustness to existing planning that's there already. And I know I have to stress this to any of the advisory community, whether they are in the fiduciary or the trust or even the bankers or the family office space, whatever it might be. The private placement there is another tool to support you in delivering great solutions to your clients. It's not there to replace, right? And I think, insurance has always been the cornerstone to any successful estate planning or tax mitigation strategy. But so many times I see it's overlooked and actually to the detriment of the client. Okay. So moving along now, I think I've already touched on some of the stuff that PPLI can do. I think some of the big issues, certainly for the trustees, are on the call. It's the reduced complexity. As you know, as a trustee, you need to report every year on the assets that are held by your client. Where are they? What they're doing? Almost line by line, etc. Which one is convoluted and time-consuming. Obviously, errors can created. And also people don't want this kind of information flying around, all right? The use of a PPLI structure simplifies that in the basis that you're only reporting the insurance policy, all right? Yeah. So you have Mr. Smith, well, let's say old days, you have Mr. Smith, he's worth 100 million, and he's got yacht, jet, art, jewelry, watches, classic cars, and so on and so forth, investment portfolios. Now it's a case of Mr. Smith, he's 100 million, he has an insurance policy, and that's it. Now, this is all CRS and FATCA approved, remember, okay? So it simplifies the trustee's job most significantly. And of course, we don't want that kind of information to that detail floating around the interweb as it is nowadays for fear of that getting into the wrong hands, etc. Right? The other important thing, I suppose, as well, is that, and again, we're wanting to make sure that these assets are passed in a timely fashion on to the family members. So by having it inside the insurance structure, we mitigate things like probate or any kind of forced heirship rules. As you know, I'm here in Dubai at the moment, so we, the UAE Civil Code is Sharia, so that will obviously create more complexity in making sure those assets are moving to those individuals concerned. Again, PPLI obviates that problem, and so you can have predetermined beneficiary designation within inside your private placement structure. By the way, these could be changed at any single time that you wish, for a very, very small amount of cost, if any at all, okay? And so this is, again, nobody thinks this is important until it becomes important.
Yeah.
And then, of course, it's too late, right?
Absolutely. And I mean, Sharia law is a critical one, but also deemed succession or forced heirship, because that's something we have here in Mauritius. And we always say to families, it's usually not a problem, but where it is a problem that you want to leave your assets to someone else other than your children, it's it's very hard to find a way around it. So this is quite a nice solution to around those rules.
Yeah, and of course, it's not a good time when a family member passes away,
Yeah.
and we need liquidity. Now, as you know, complex families have complex affairs, and so they have not just assets in the home country, but all over the place.
Yep.
And when they pass, of course, probate needs to be done now, but probate needs to be completed in every single jurisdiction before now funds can be released to the remaining family members. If you then add a layer of complexity on top of that with Sharia, again, that's creating more complexity, which increases, delay. Now, for some families, that could be crucial because maybe there's a liquidity event in terms of keeping a company going or a payroll, or the fact that there is issues with liquidity within the family could affect them because they're a publicly listed family, right? So the impact is huge, and basically, people need money in a really difficult time when a family member passes away, and without correct structuring, that can be a huge problem for them, right?
Yep, makes sense.
Moving along. What have I come into now? So I'm basically going to do what we used to call in sales a bit of a Winston Churchill, where the good things and the bad things, and what will this do and what will that do, etc. So what I've basically done is just a couple of headliners here to say, what can we expect to get from PPLI. As I've already mentioned here, when we're investing in places like America, it does trigger things like estate taxes. It triggers things like withholding taxes. And again, if we can mitigate those, these are not insignificant taxes. I mean, to be hit by 40% on your estate when you could avoid it legally, it is crazy, and unfortunately, families tend to find out the hard way, and then it's like, what? I thought these structures were going to protect me. No, they're not. So it's a case of the planning needs to go into effect immediately. And I think, with all people in the advisory world, you don't just set something up and leave it. You've got to go and look at it and see if it's still relevant to what's happening in the world, what's happening within that family, and are our assets protected for now and for future generations in the best possible way we could do it. Okay. So, so I'm talking about things like, tax deferral, and in some cases you can get, exit of tax-free, depending on where, the assets are being taken. Inheritance tax comes up a lot, particularly when we're talking about, UK assets. A lot of wealthy families, again, from around the world, buy property assets in the UK. It's one of those things to do once you're wealthy, etc. But of course, what's happened recently, how do we mitigate that inheritance tax? And again, HMRC are quite aggressive. If you don't get that tax paid within 6 months, we don't care what problems you're having in terms of complexity in the family or delays with probate or Sharia. We want that money within 6 months. Otherwise, we reserve the right to fire sell the asset or indeed confiscate it altogether, right?
Yeah, quite
Again,
scary.
not good, not good news when you're going through a fairly tough time as it is already, right? So this is about, as I said earlier, this is all about trying to create simplicity, building robustness, make sure that we have tax, efficiency and everything. And ultimately, this is for succession for other family members or non-family members, depending who that's going to be. All right. And we do this all in conjunction or in hand with the trustee. A trustee can be a settler and a beneficiary to a PPLI. I want trustees involved. I mean, I just touched on inheritance tax planning. So many trusts hold, property assets in the UK on behalf of their client. When the client dies, not if, because they will die, that is a guarantee, right? Where is the cash coming from? So if they have an insurance policy in place, we want that policy to pay to the trustee so the trustee can then pay HMRC. Done, swift, taken care of, done, move on. Family then gets the asset as it's always intended to, okay? And then moving along, as I say, I've done a little bit of a Winston Churchill here.
Before that,
Yeah.
we've got a couple of questions here. So the first one is, to what extent can a PPLI protect an individual from creditor claims?
It can, because remember, if the asset is held by an insurance company, technically the legal owner is the insurance company. And if someone says, yeah, but who is the actual owner? Well, it is the board of directors of the insurance company. And if somebody says, well, who is the owner? And this is the huge difference here.
Yeah.
Your client goes from being, let's say, a settler beneficiary to now what we call a policy holder. And under law, there is never any reporting of policy holder. So as far as the outside world is concerned, the owner of this asset, let's say, for example, we've got Swiss Life as the PPLI provider. The owner of this asset is Swiss Life. Yeah, but who really owns it? Board of directors of Swiss Life. So if you've got any creditor issues, you can't take this asset because that person doesn't own this asset. Swiss Life owns this asset.
Okay, good. So it does provide the protection against creditors. There's a comment here that the creditor claim query is jurisdiction specific, which I guess makes sense, but still there is it's the same point, that the owner is no longer the individual, it is the insurance company.
Absolutely right. And with all of these things, when we're talking about, creditor protection or protection from debt, protection from divorce, all of these kind of things, ultimately the insurance company remains as the legal owner to the outside world. But there has to be a point at which, and I've had this conversation with multiple providers where, if you've got some money and it's with a person when you took them on board was absolutely fine, but now he's an international drug dealing warlord, crazy loony guy. Would you give up the details of that individual to, for example, someone like the IRS, the Fed, or the CIA, or so on and so forth? Well, of course, right? That's what would happen. And probably in practical terms, the insurance company would probably unravel the facility that they have. They'd give obviously the client ample notice beforehand to say, unless you can resolve these matters, we're going to have to step away from this, providing this service to you. So I'm not saying it's a, it's a catch-all for anyone and you can bring anyone and everyone into, no, and certainly anyone who's sanctioned can't have a private placement, etc. So we have to keep an element of sense about this, right?
Makes sense. We have one
All
more
right.
question.
Yeah.
Can a trustee realize assets within the PPLI to make a distribution?
It can, and again, this comes down to what permission or the discretionary powers, for example, the client has with his trustee. So if, let's say, for example, in the event where the client is still alive, let's say the policyholder, stroke what we call UBO, is still alive, and he wishes to make a dispersion from his PPLI, he can do so, and he can do that through the trust. If he's given discretionary powers to his trustee to act directly with the PPLI provider, and obviously there's a piece of paper in place between the two to show what those powers are, then of course the PPLI can obviously make dispersions from the trustee rather can make dispersions from the PPLI to those who are supposed to receive it. And again, depending on the people receiving those proceeds, you would do it in a way that, is it going to be either a pure dispersion in terms of redemption, or could it be seen as a loan, for example, because there's tax implications depending on who's receiving that money. Okay, so we, again, hopefully between the PPLI, the trustee, and if I need to get back involved again, we discuss on what is the best way to actually affect that kind of transfer.
Makes sense. Guys, keep the questions coming. It makes it much more relevant for us to discuss questions as we go.
Yeah, about PPLI preferably, right? Yeah. So here, what I've done here is I've just given a little sort of, a Winston Churchill on it. The work that mostly a custodian will have to do, etc., when reporting, compared to what an insurance structure will have to do, obviously is somewhat different. And you're probably wondering, well, why do insurance companies get all of this treatment? Well, I mean, referring back to the US, I don't think there's been any change in US insurance laws since 1981. Obviously, the big insurance groups, I've already mentioned someone like Swiss Life, but in America, you got AIG and so on and so forth. They're very much, joined at the hip with the governments. I mean, they buy most government debt and so on and so forth. And also insurance companies, they're investors themselves. When they take your premiums, they don't just like leave it in a bank account. They too will invest in various assets, whether it's real estate, investments, could be private equity, a whole range of things. Insurance companies have very diverse portfolios, and they manage some of the biggest funds are insurance funds. They manage trillions, etc. Right? So there's a little bit in terms of reporting. Now, unfortunately, I've done a couple of these line reporting type examples coming up now.
Can I just go back
Yeah, sure.
on the last slide, Tim? So when you say custodian, is that the trustee?
Yes.
Okay, we have a question here that asks to explain the difference between the trustee and the insurance company. Can they be separate? So I assume they're almost always separate, but can you give us a bit more information on that?
Most definitely. The trustee is very different to the insurance company, right? And you can have you can manage your assets purely with a trustee alone, for example, and that's worked for many decades already. You could actually go directly to a PPLI provider and omit any use of trustee. But what tends to be a sweeter operation is that you have the two conjoined and working in parallel to make sure that the assets are managed in the best interests of the client. Because when you're a trustee, you might have all sorts of weird and wonderful requests through your discretionary powers, and that, through your letters of wishes from the client that will say, look, in the event of my demise, I want this son to get that, this son to get that, this daughter's going to get this. They're not to get a lump sum. If he starts taking drugs, he's not getting anything anymore. He's not allowed to get into this kind of business. So all of that granular detail that a trustee should have on their client, they will ensure that these assets are portrayed or presented to the family in those wishes. The insurance company will not go to that level. They'll just say, how much do you need? Where are we sending it to? We're not going to debate or whatever. We have an instruction. It's in line with our mandate, and we will send that money. If little Johnny now starts taking drugs, whatever, or that we shouldn't be paying that anymore, that's not our oversight to do that. All right. So this is why I always say that, PPLI is not a replacement to trust, because it hasn't
Yeah.
been for the last 40 years, and it shouldn't be now. They should really work in tandem.
Nice,
All right.
thank you. We've another question. If you can please highlight the UK inheritance tax avoidance mechanism. So how can we use the PPLI to avoid the UK inheritance tax?
Right, good one. That must be a loaded question from someone in the biz. Um, Look, I'll be honest here. Look, I am aware of PPLIs being used, if you like, as a blocker or to avoid inheritance tax. But anyone who knows in the industry, it very much comes under anti-avoidance. So PPLI is actually considered quite aggressive. The cases I'm aware of where done on the basis that it was not trying to get around inheritance tax, but more around creating privacy for the client, because he was from China, had left China, had managed to get his funds out of China, and helped a lot of other people get out of China and their funds too. And they were worried about China HQ coming for his assets. And so with the use of a PPLI, what he managed to do, of course, is regain some privacy and a robust structure that would be impenetrable to anyone trying to find out what was actually inside. So the game plan was not to avoid IHT, but to create privacy. When people talk about using PPLI wrappers to mitigate UK IHT, typically with CITES, I'm talking about residential property, I would always red flag it to say that's highly aggressive. With regards to the new rules that came into the UK 2017 with regards to inheritance tax and how it affects pretty much everyone and anyone now, regardless of the holding structure, I still find many families today are not aware that their trust SPV combo will protect them anymore
Yeah.
from inheritance tax. The only way to get rid of it nowadays is you either sell these assets you have in the UK and get out. You can gift the assets to someone else. That could be typically a family member or anyone else, and survive 7 years. Certainly the families I speak to in this part of the world, which are very patriarchal, once they understand the legal implications of gifting, i.e., once you gift this asset, for example, to your son, he now owns it. And if he chooses to sell it the next day and spend the money on fast cars and fast ladies, there's nothing you can do about it. So they generally don't like that. And also they lose access to the property as well. So the last option I do typically would not be a PPLI, but what I call a high value insurance solution, which will create the 40% liquidity on death. So you can pay HMRC immediately, and then the asset passes clean and clear to the family. I might design it as well so it pays off all the debt, because of course, when you die, the person who created the debt doesn't die with you. So I do that at the same time. But I think IHT, based on the call that we had before, for example, and using insurance is probably another call we could do another time when I could go into a greater depth. But PPLI, IHT planning, aggressive. If anybody knows of it, please reach out to me and I'll give you a sort of chapter and verse and where I think it can work and where it can't work. So there you go. Shall I move on?
Yes, please.
Yeah, okay, here we go. So yeah, so I'm basically reinforcing a lot of the stuff that I talked about here, and where I'm saying this is the traditional route where you have a settler and he opens up a trust and then he has his custody account, typically with let's say a bank, for example, and he gives the bank a mandate to run all his money, for example, right? What we're saying now is that you could move into something along this kind of lines, where you have the settler again sets up a trust. You then have a PPLI in between, and the PPLI will then go to the bank and then open up, various investments for you, and so on and so forth. I've used the term barrier in there because, again, people, for example, who are rearranging or reviewing their planning in the UK, again, trustees are reporting that the person is either a UK domicile, a UK res domicile, for example, and that's obviously going to maybe potentially trigger some chargeable events for them. If they could then report that the UBO technically now is an insurance company, there are some great tax benefits for doing that. And again, there's another session that you could do on things like foreign income and gains in light of the new tax changes that are coming through. But I don't want to focus this on a UK tax type play today. I just really want to give the overview of what PPLI can do for people, etc. Right? So the mechanics of this, you know, I've already said that, you know, you can set up the trust, or you can get the trust to set up the PPLI. There's various permutations that we can use to basically fit what is right for the client. I've then got some examples here, and I apologize in advance for lines and boxes. And of course, these can be drawn in different sorts of ways. You can have basically, you know, you don't lose any of your relationships with your bank. So when you have a PPLI, you can still have the same relationship with your bank, or even a lot of PPLI providers have relationships with existing banks already. If you're banking with a certain banking provider, but that insurance stroke PPLI company does not have a relationship with that bank, it can be set up. Sometimes it can be done very quickly. Sometimes it can take up to 3 to 6 months, depending on how slow the bank can be. All right. But at the end of the day, utilizing your custodian, if you're happy using, for example, JP Morgan, then we can either use the PPLI provider that's already got terms with JP Morgan, or we set the terms up with JP Morgan. All right. The beauty of this is that, you know, you're now gaining all of your dividends, for example. They're tax deferred. They could be tax free depending on how you're taking them. Of course, you're doing this privately. You know, there are some people, for example, who hold positions in public companies that obviously have to report if they invest or divest in a public company. Obviously, if they did this through an insurance company, then of course there's no reporting at all. There'd be no conflict of interest. And I think, you know, by just utilizing these structures, there's another great way of doing things. And I can't think if I put this in here in terms of lending. Yeah, I think it's my next one actually. And again, my apologies for the box and the squiggly lines, but sometimes when lending, the use of a PPLI is actually quite important because, as you know, the credit committees within inside banks are very, very dubious about lending to jurisdictions that they're not friendly with, for example. So if you have the assets that you're looking to lend against inside an insurance company, and then you go to the bank and say, we'd like a loan, it improves your chances dramatically because the credit committee are now basically lending to an insurance company. They still know all the underlying assets. That's all disclosed, of course. But in terms of the credit committee lending, they're now lending technically to a major insurance company. That gives them comfort. It's very easy for them to collapse the structure. You can put credit insurance in place, of course, as well. And so you get comfort with utilizing a PPLI when it comes to maybe monetizing assets. For example, let's say, UBS would not lend to a factory directly in Kenya, for example. But if the UBS in Switzerland were lending to a major insurance company and the insurance company then sent the money on down to Kenya, that can be facilitated. And, you know, we've got examples of that should anybody want to share.
That's a
It's
very
great for the
interesting one, Tim. I wasn't aware of that because often, you know, the types of jurisdictions we deal with are often not regarded as wonderful jurisdictions by the big international lenders. So that's a very interesting
correct.
benefit.
Well, let's assume, okay, you're a businessman in Kenya. You're probably not getting the most effective interest rate on your loans with the bank, because the banks know where else are you going to go. You know, and of course the client knows that he can't get institutional lending with someone like UBS. So with the use of a private placement, you can basically, you know, as long as your assets in Kenya, your assets are in a corporate structure, they have a credible valuation on them, for example. You can then take that credible valuation, those corporate entities, into a PPLI structure. You can then go to the bank and whatever you're looking for, 50, 60, 70% LTV based on those assets. The money's then come into the PPLI. The client will probably then, what I've seen before, is pay off the local lenders because they're getting ripped off. You know, they've still got their assets under control. And then maybe there's some money left over where you give that back to the lending bank to tell them they're going to run a portfolio for you. Everyone wins, technically speaking. All right. But to do it in the, how do I say, the old ways of doing it, yeah, you're probably not going to get involved, right? It's not going to happen. But
So we've got a
this is just
question
another
on
example.
we've got a question on this. So in this Kenya example, is it financial assets in the PPLI or the real Kenyan assets?
Yeah, it has to be the assets that the client
Of the
has. So let's
business?
say, for example, he's got a bicycle factory and he makes, he's making $10 million a year. They generally don't want the revenue to use as the balance sheet. We want the value of the bicycle factory.
Yeah.
Now, if
So it's
that
the
has a
real
credible
assets.
value, yeah, has a credible valuation from, a decent valuation company, and then that is in a corporate entity, and I'm sure that's where many people on the call would come in. If it's in his personal name, we can't work with it. It has to be in a corporate entity. Moving that entity into the PPLI structure, again, we'd have to look closely. Is there any chargeable events that will happen as a result of doing this, etc.? And again, that's where I defer to folks like yourselves, etc. But now you have this insurance structure, which is technically A-rated, asking for a loan against these assets. And if the bank is willing to do it because of the benefits I said earlier, that they're happier lending to an insurance company, that they're happier lending to an entity, which is very easy to collapse. You can put in things like debt protection insurance in there as well, etc. And then the PPLI goes back to their policyholder, their UBO in the old terminology, and say, here's the cash. What do you want to do with it? And so the first thing you do is then pay off the local lenders or who he's borrowing from, for example, because he's not getting a good deal. All right. So that's an example there.
Great. And we've got another interesting question here. So if the high net worth individual places complex luxury assets into the PPLI, so stuff like yachts, fine wine, rare coins, artwork, who
Yep.
is typically responsible for the ongoing management of those assets on behalf of the PPLI provider?
Yeah, generally. So again, if you have those kind of assets, I mean, most yachts, jets are owned by a corporate entity, right? And those corporate entities will have a management company with them. So again, the PPLI provider is not going to get involved in the day-to-day, managing the crew of a yacht or the insurance of the yacht or the charter of the yacht or so on and so forth. There has to be a management company involved in that still. The management company, for example, let's say for example, they're doing charters in terms of a yacht or a jet, those monies would come back in and they would eventually bleed back through to the PPLI, right? And then within the PPLI, the bank, the UBO or the policyholder, I should say, will have one bank account. He might have multiple banks accounts where he can then move money around depending on how he wishes. The same thing if you have art. Generally, the art will not be, well, I've got it on my wall here. It's got to be in a specific holding area. Whether it's going to be gold, whether it's going to be art, whether it's going to be jewelry. Typically, again, we're not going to put in a PPLI, a fancy watch you have on your wrist. It needs to be in a secure environment, and then, of course, in a corporate structure to allow the PPLI to absorb it into the structure.
Makes sense. Okay, great. Thanks.
All right. So moving on along again, I think I might have brought this up again a little bit here. Yeah, so this is really, I think the main reason that PPLI is used is about creating, obviously legacy, and to build succession and intergenerational wealth transfers into to any family. And again, not just with the usual, here's a lump of money, but also all these other more tropical assets, which we just mentioned, things like yachts and jets and art and so on and so forth. The beauty of this, of course, is that when these assets are passed, it doesn't come into the public domain. It's all done. There is, there's none of this issue of, typically when someone passes away, everyone comes out the woodwork: wives, ex-wives, girlfriends, boyfriends, illegitimate children, and so on and so forth. And the fight begins. The lawyer's like, ticking the box, and here we go. We're off to the races. By having it all structured inside a PPLI, you can avoid a lot of that, because it's predetermined beneficiaries, and you can have everything under one umbrella. Now, that doesn't mean I always use one PPLI. As I mentioned at the beginning of this conversation, there are certain PPLIs for certain jurisdictions that have specific attributes in terms of mitigating tax. So we might use one of those specifically for a specific asset because maybe the client's got a castle in France or he's got a large portfolio in America. So we'd have a different PPLI for that. And then we might have an international PPLI for other assets. So there's not one PPLI solution for everything. We still have to use multiple providers, different jurisdictions, different structures to obviously optimize the outcome we're looking to get for our client. All right. So this is what we can do. And of course, things like insurance policies can pay into a PPLI policy. So if the client has a high death benefit insurance policy already in place, he could either have that paid to the family members or prefer to pay it into his PPLI, and the PPLI, in conjunction with the trustee, pay that to the beneficiaries as predetermined, etc. Right? And again, it just keeps it all private, keeps it tax-free or tax-deferred, most essentially, and away, all the asset protection that goes with that as well. All right.
Makes
So I'm pretty
sense.
much getting to the end there because I know we were trying to do at least, let's say, 30 minutes. We're pretty much there. We've got some calls or questions coming in, but look, I think with all these things, PPLI, it has been around a long time. There's even someone posted a comment on LinkedIn this morning about, well, it's been around for ages, and it has, but it's been a pretty much of a slow burn in terms of it being commonplace amongst fiduciaries and trustees, and certainly some of the family offices that I work with, in terms of fully understanding, appreciating the benefits that PPLI can bring. And I think I'll be honest with you that a lot of the Swiss banks, who quite frankly they bank some of the most tropical people in the world, let's say. When some of these people suddenly get into the public spotlight, whether it's an SFO or some negative press, banks will typically, they'll get a call from FINMA to say, who's banking this guy? Oh, we are, right, freeze his account, which means the client now has no access to capital. Now, look, it could be that there's an investigation and it might take up to 3 to 5 years. And it might come back that, oh, there was no case to answer after all. But I've had my money locked up for the last 3 to 5 years while you did your due diligence and investigation, and that's really hampered me massively. So what the banks have done typically is use a PPLI structure around the outside of the bank account. So when FINMA says, right, who's got money with this guy? They can go, well, we don't, but we have money with, say, Swiss Life. We don't have to report anything further than that. All right. So this is really where, there's multiple uses of how PPLI can come in and blend with existing planning, or to make, let's say, legacy planning more robust. And I say to everybody, just drop us a line first and foremost. We can talk it through. I don't need to know the names and, of anyone, but we can just create shapes to what might happen and what could add value. Of course, cost will always come into it. But I think, the costs are always outweighed by the benefits that PPLI and various other insurance structures can actually provide for their clients. So really, it is a case of, don't overlook insurance. Get it. I know it's always been there. It's the cornerstone to any financial plan. But, I meet many, many high net worth clients who've not even got any insurance planning at all in their strategy. And it's only when you tell them why we consider putting it in that they suddenly go, wow, why didn't I know about this before? All right.
Yeah, and I find it very interesting, that it's not often talked about. And as you say, it's been around a long time, which I like. This isn't some sort of newfangled, untested product. It's got a strong
Yep.
history. As you say, reputationally, governments understand insurance products. They don't view them with suspicion the way they often view trusts or foundations. And I think the benefits in terms of certainly liquidity, I mean, that's a massive one. And even for very wealthy families, often liquidity is an issue, and it's an issue, as you say, when someone, often the patriarch, passes away and bank accounts are frozen. So a PPLI just for the liquidity alone can be a huge help. And of course, the easier reporting, I think, is a big deal. And not because people necessarily want to hide things from the taxman, but you don't want all of your information flying out there in terms of all the assets you own. So having them kind of neatly packaged up in an insurance product, I think can give a lot of benefits. Well, thank you very much, Tim. That's been super interesting. And I think it's clear that it's not a sort of off-the-shelf product people can just shop as a magic solution. I mean, those days are gone in terms of tax planning, I believe, but
Yeah.
definitely
Yeah.
something to consider when we're looking at structuring for families. I'm just checking if we've got a few comments, but no specific questions. Oh, so here's one. What happens when the value of the assets in a PPLI take a hit?
Well, it doesn't really matter because it's just the asset. If they're taking a hit, as in terms of they've gone down in valuation, for example, that's no different to them going down in valuation inside an SPV or a trust
Yeah,
structure.
exactly.
You know, if you've got an SPV owning some private equity and you know, you think it's worth 10 million, you know, it then goes to IPO and it comes out it's only worth 5. It's worth 5 then. You know, in terms of cost to the client, actually a drop in asset value would obviously reduce the chances of the client, because most PPLI providers will charge a percentage fee of the assets held within the structure. So, you know, if it's gone down in value, whilst that's not great, it's good that he'll save on his fees a little bit.
Yeah, and it's sort of similar to the question around, well, who manages the complex assets in the PPLI? The same person as would manage them otherwise. And the value, if the
Correct.
value changes, it would change anyway. Okay,
Correct.
another question here. How much management fee is typically payable for a PPLI? Is it a percentage of the assets or a fixed fee or any other formula for calculating it? I know that's a difficult question, but can you give us a guideline?
Yeah, look, it's an open question, because it depends on who is the client, where is the client, what are the assets, the complexity of the assets, do we have to do, you know, EDD and so on and so forth. I think as a ballpark figure, you know, if you're paying an establishment cost, which could be anything, say up to 1% to establish something with a provider, and then, you know, let's say a 1% per annum ongoing cost, right? Now, you might think, oh, that's a bit expensive. But again, I go back to my earlier point, which is if I just, you know, saved you 30% withholding tax, but it's going to cost you 1 to get it. And my Labrador can do that kind of maths, right? So, so I think, you know, by not having these fees in place, the impacts to the family vis-a-vis whether it's withholding taxes or estate taxes later on, or just the fact you want that, you know, estate preservation and privacy and so on and so forth, you know, it's got to be done now, not later, right? So, as I say, there are huge benefits to blend PPLI with existing legacy planning structures. And all you've got to do is be open to the idea, and you know, contact myself and people like me to, you know, to try and work out what's best for this client once you review them. And what I say typically is that something was set up 20 years ago and you just take your fee every year as a fiduciary, when actually, should we go and look at this and see if it is still relevant? But more importantly, I think clients just want to know there's value being added.
Yeah.
So if you're just one of these professionals that just say, well, we do this, we charge on this and that's it, nothing else. You know, I'm always getting asked by clients about, what about this? What about that? I think I mentioned to you before, you know, they've just got a yacht here now and they want their yacht insured. I don't really do that stuff, but I know people. And so I can
Yeah.
then pass them on to someone. Can you get the yacht insured, please, etc. And if you don't know how to do it, or you can't do that level of insurance, get to someone who can. They want solutions, right? And that's the value you can bring by saying, so look, I know we do this, but have you considered this? You know, and there's plenty of information, whether it's my website or I've got a YouTube channel as well, which, you know, you can find out all sorts of information, share it with your client. Or as I say, I never have a problem with someone picking up the phone, give me a quick call and we can talk about the shape of a potential solution. And if I can't help, I'll tell you, it's not relevant in this situation.
Great. Thanks, Tim. Okay, guys, we're going to wrap up now, unless there are any more questions before we leave. We will be sending the slides and a recording of our webinar to everyone who's registered. And my and Tim's contact details are on the last slide. So feel free to contact us if you have any more questions. Otherwise, Tim, thank you so much. I found that a really interesting discussion, and I'm glad to see there does seem to be in the attendees a good understanding among some people of what these products are and how they can be used. So that's quite encouraging. So thank you very much for your time, and I hope we speak again soon.
Definitely. And thank you for allowing me to come on board today. It's great fun.
Okay, guys. Bye-bye.
Bye now. Bye-bye. Bye.
Bye.